Thank you everyone for joining the August 2023 real estate market update with Catalyst Funding. Got past some or most of the technical difficulties. Our founder and CEO Wade Comeaux is still having a few technical difficulties with his access to this webinar. He'll be joining us hopefully shortly, but right now we wanted to dive in and make the most of this hour. And so with that, I'll go ahead and introduce Jeff Johnson, our Director of Lending with Catalyst Funding.
Hi, everybody.
And we're excited to have back as a special guest. I know last time we had him on, it was a great webinar. We have Steve Curtis with the Curtis team and SecurityNational Mortgage Company.
Thanks for having me, Derek.
Thanks for being back. And again, this is the August real estate market update. Wade Comeaux, our founder and CEO, will be joining us hopefully shortly. Thank everyone for your patience, and we're going to go ahead and dive in though. I'll offer this disclaimer. This presentation is for general information only. No information or any estimates presented here represent any final determination on investment performance. We just want to provide valuable information, and this knowledge is for you as you make the most of your real estate investing, and we are not having any liability for any loss or damage that you may occur. That is our disclaimer. We're excited to dive in though to the market report for Texas for August of 2023. Steve, glad to have you back. Jeff, I'll let you introduce Steve a little bit here.
Yeah, sure. Thanks, Derek. So Stephen, I've known Stephen for maybe a couple of years. I know he's worked with Wade for a really long time. But Stephen is the leader of the Curtis Group. Very happy to have him on here. I know they do a great job. They are located down on the south side of town. They do a ton of deals, on the owner-occupied space. But Stephen, welcome. And why don't you tell the folks a little bit about what your group does?
Yeah, thanks, Jeff. So we have 3 locations across Houston, mainly focused on owner-occupied purchases. We also do refinances and Texas A6 cash outs for people that want to access equity, which ties in perfectly with real estate investing. We are normally, for purchase transactions, if you take out the new construction space, we've been the #1 purchase transaction lender in Galveston County for the last 5 years. So we do a lot of work. It's all in the community. It's grassroots movement. It's all relationships and word of mouth. So doing things like today are a big deal for us because we get to get in front of new people and try to bring value and create new relationships. So I really appreciate you having me on.
Of course. Thanks for coming. I know working with Steve and Mike over there, they do a great job. We have a lot of referrals back and forth between customers, and we always hear great things from our investor clients that work with Steve, excuse me, and his team to maybe purchase a new property or do a cash out on a property they own. They do an outstanding job, get the deals closed fast, and they're great to work with. So I can't recommend them enough.
Thank you, Jeff.
Yeah. Next slide. So I'll briefly go over the Catalyst value proposition. I know for most of you folks, if you're returning, appreciate that. If you are new, I'll just give you a brief overview. We consider ourselves a one-stop shop for real estate investors, focusing primarily on hard money, whether it's either for a flip or a hard money loan, and then you refinance into a long-term loan. We can do both. We were lenders built by real estate investors. We started as a real estate investment company before a lender, and many of our staff are investors as well. Love to hire new folks and they come in and start doing deals. It's great to see people get into this business. Involved in thousands of transactions. We pride ourselves in having one point of contact for all of your needs. So whether you're doing a long-term loan, a short-term loan, we have one loan officer that can take you all the way through the process. We do hard money, conventional, and we do a ton of non-conventional loans these days. So for folks that are real estate investors, either you've done so many you can't do conventional loans, or maybe you write off a lot of stuff on your taxes and you don't qualify for a conventional loan. I've talked to tons of people that they thought they had to be out of the game once they maxed out their conventional loans, and that is definitely not the case. There's a lot of products out there for investors, whether you go conventional or not. Like I said, we do primary refis, purchases and cash outs, products with FICOs as low as 620, and obviously the DSCR loans or the non-conventional or no income doc. So if you don't want to provide your income taxes, that's quite all right. We have a loan products for you. Next slide. All right, so I'll dive into Houston. I'll kind of go over the stats and then Steve, get your feedback on what you think. So in July, there were 37,000 active listings. That number is up from a year ago, but it is down from 2019. We always like to put year-to-date numbers, but then we also look at pre-COVID because the COVID market over the last year or so was so unique that sometimes people will lose perspective on what a normal market looks like. So we always compare last year, but then we go back to pre-COVID from 2019. So single family home sales, 7,500, that's down 8% year over year. The average sales price, 428. So it's pretty much flat from last year. And if you look 4 years ago, it's up quite a bit, 37%. Median sales price slightly down from last year, but again, if you're looking at it over the long term, 4 years later, that's a 36% increase from 250 to 340. Months of inventory, 3.2. That is up a little bit from last year. Still a very strong market, nowhere near a 6-month mark, which is kind of a platform that people look at to see a balance, a shift from buyer to seller and vice versa. And then pending sales, 8,400 pending sales, days on market 42, which is up quite a bit from last year, 16 days. So Stephen, what if anything on here jumps out at you when you take a look at these stats?
One of the things that I mean, on the street, we're seeing more inventory. We are. But where it's comprised of is what is kind of hiding in the numbers. And I think we're going to get into it because even though we do have an increased amount of inventory, a lot of it is coming from new construction and we need more of it to come from the resale market. And with people having historically low rates on their first mortgages, they're reluctant to list. So we are getting more inventory, which is good because the buyer pool is still clamoring for inventory, but a lot of it is coming from the new construction sector. And I think we're going to see that later in the slides. So we're still a long way from a normalized inventory market. And I think when you kind of strip out new construction, you're going to continue to see prices be flat or, maybe even increase if rates go down a little bit because there's just not a lot of homes. There's not a lot of homes for sale for the people that still want to buy. And there are still a lot of people that want to buy. We are still seeing good activity in people wanting to apply for new mortgages in the market of the Houston area.
Yeah, I just wanted to say hi to everybody. Unfortunately, I had a fire alarm in my building and was unable to be on the call at the beginning. So it's been a little bit of an adventure. I may have to step off, and if I do, I apologize, but I think we may be in the calm after the storm and hopefully I can participate on the rest of the call. Welcome aboard, Steve. Super excited to have you today. And appreciate everybody's patience.
All right, next slide. So Dallas has been a great market, very hot. So if you look at there are fewer home sales, right? 8,200 versus 7,600. That's down a little bit. But if you look at the average sales price, even in a softening market in a lot of places, the average market for Dallas is slightly up year over year. But if you look at 2019, it is up an obscene number, 61%. From 320 to 5, basically 320 to 520. You bought a property. The average price in Dallas, you bought it 4 years ago. You paid 320. You have almost $200,000 in equity on average, which is really amazing. Median sales price 415, down slightly from 420. Again, going back to 4 years ago, it is up over 50%. Months of inventory 2.6. Compared to Houston's 3.2, so Houston's a little bit more inventory than Dallas, which makes sense. Pending sales 7,400, down obviously, but not drastic. Days on market is quite a big difference. So 39 days on market. You compare that to 46 4 years ago, that's pretty normal. A year ago, 20 days on market, that is a really low number. So the days on market is a little bit longer than it was last year, but still a pretty normal normal real estate market. Dallas is very vibrant. It's going through a bit of a growth spurt, in my opinion. Steve, Wade, do you guys have anything on Dallas?
That's a really tight market. I think it's going to be, and they're building a ton of homes in the Dallas Metroplex, and they still cannot create enough inventory, which is why you still see average sales price increasing because it's a lot of new construction, and that paired with lack of inventory is going to continue to have upward price pressure. I think you're going to see that in Dallas for maybe two to three more years. Just need more inventory.
I would tag on to that. Yeah, absolutely, for sure we need more inventory. It's going to tag on to the overall thought here that in Houston, I think it is but I think Dallas is probably the best flip market in the state at the moment based on these metrics. Value is holding strong. I think a lot of upward appreciation opportunities and the most tight market. And we're going to talk a lot in the meeting today. I had a perception, I think some other people did, that the real play in the current market was going to be buy and hold. But we are really seeing a lot of data and a lot of other indicators that it's a very good flip market because of limited inventory. And despite the fact that rates are really high and that it is costing more to get into a home, some people do need to buy homes, especially the influx of people moving to the state. And because they have so few options, that's why we're really starting to see savvy investors getting into this flip market, especially in a place like Dallas.
So I'm curious, Steve, you're talking about new construction. Where are you seeing the price points on these new construction deals coming across relative to these numbers?
So relative to these numbers, I think they're 8 to 10% above whatever their actual market is. Like an area like Dallas is so big, you have to look at Denton different and McKinney different. But I think everywhere it's 8 to 10% over what the normal market for resale is, right? So a lot of our construction in Houston is, out towards Katy or north, or you have some south towards Brazoria County, a lot of construction. In every one of those areas, it's 8 to 10% over the resale, right? Because they're creating the inventory. So Wade makes a good point about flips. Right now, the resales that are going on the market, they're not necessarily in a hurry to paint or do any updates when they put it on because they don't have any competition. So if you go create a home that is now inventory through flip and you do a good job and it's updated, I think you're going to be in an advantageous position, especially if your price point is under new construction, because you're going to get a home that's newer. It's going to be more competitive than the homes that are on the market, and people are going to be looking for homes that they can move in. With cost of acquisition being as high as it is, if you can have people move in and not feel like they have to do as much, you're going to have the more competitive home.
All right, next slide.
So I'll hop in here, Jeff, for San Antonio.
Yep.
So San Antonio, in our perception, is one of those top 2 markets for buy and hold investments for a lot of different reasons. That price point is significantly below the price point for both, well, definitely for Dallas and Austin, and even shade below what you see in Houston. So it's an approachable price point for the buy and hold investor, but also because of all the activity there in the Austin area with IT companies moving in. There's also a very robust flip market there at the moment as well. But whenever you look at the numbers overall, I think you can see the price point is definitely significantly lower. The year over year inventory number is at 3.8, so it is increased, but basically pretty much a stabilized market when comparing back to pre-COVID July 2019. The days on market is the highest between San Antonio, whenever you're comparing to both Dallas and Houston by a relatively large margin, but it is slightly below Austin at 59 days. So what I think we're seeing here is it's not as nearly the quickness of the market, not as hot as Dallas is, but in range of Houston, but really a good market still for buy and hold because of the approachable price point. Steve, are you guys hearing anything about San Antonio in particular, Steve?
No, not in particularly in San Antonio. I will say just historically, it's been the most affordable of the 4 major cities. So it doesn't surprise me that the average price point is lower and takes longer to move. Also, a lot of military personnel that live in that area. So I think sometimes the pay range of that helps drive the affordability factor. So I think Austin and the DFW area are a little ahead of Houston as far as appreciation. I think Houston is the most balanced market, and then I think San Antonio is the one that moves the slowest. But I mean, it's just been that way from a trend perspective.
Yep.
So I'll cover Austin. Austin is, let's see, 462 for median sales price. So there's not quite as many stats, I guess, coming out of Austin. So it's down 10%. You're not surprised. Austin had the biggest run up. You know, it's the most SoCal type city we have here in Texas. It had the big run up during COVID, and now it's got, you know, a little bit more of a decline than the other cities. Months of inventory, 3.7, still a very solid number. Pending sales, it's actually more sales right now than last year, which I guess isn't that uncommon. Houston's the same way. And 59 days on market. That is the longest of the 4, which is, you know, funny because I remember when we first started doing these, the days on market in Austin got down into, I swear, almost like the single digits. Like it was just ridiculously low. So, you know, things have definitely normalized, I guess, out there in Austin. Also a point where you might be able to get some bargains out there, I would think, because it's still a great city. A lot of companies are coming there. It's different than the other places here in Texas. So I am curious if if the price is gonna come so far down where it does start to make more sense to start looking to invest and buy some properties there.
I think it's a good time in the flip market. We're going to see some data as we go through the presentation, anticipating future prices. That Austin is a very strong market with several different prognosticators, and it's all based on data, but there's some very strong data there. I think it was one of those situations where the pendulum swung too far up in a very short time frame, and it did need to correct. But if you still look at that pre-COVID number in a 4-year period, up 42%, that's still very strong despite the last year. Yeah. And as far as the overall job market, I think it's very strong compared to a large majority of the country, but not quite as strong as what we're seeing in that Dallas market at the moment. But I really think Austin is going to be a good flip market. And if you get into the outer areas or you move into those duplexes, triplexes, and quadplexes, it can also be a good buy and hold market. Just the price point is so high with that median sales price of 462. It's not a great single family buy and hold environment unless you really get to the outskirts and get a lower price point. So this next slide is some of the data we're talking about long-term trends. We will cover exactly how this organization built out their numbers, the way in which they project future appreciation, but some very exciting results from this Wallet Hub evaluation, which came out in August. Number 1, it names McKinney as the most attractive real estate area, followed closely by Frisco. So those are 2 north of Dallas suburbs that are really crushing it right now. And as we go through the remainder of these numbers, and if we go to the next slide, we can see a broader view here. And you can see that, well, actually we go over the weighting, which I'll cover. I'll go ahead and cover the weighting at this point. Sorry for getting mixed up on where I thought we were going to go. But as you can see, the home value forecast, which is based on some Zillow information. We also have the median home price appreciation, median days on market, share of seriously underwater mortgages. They have some other factors about ratio of rent price to sell price. A lot of really good data that is evaluated for all of these markets across the country. If you go to the next slide, we see Housing affordability, which is double weighted, that's a very important number because it says, in that given market, the average income, how that correlates to the average price of a home. And we know Texas markets consistently crush that metric. Very affordable, but also a robust economy, strong job market. They have even things as going into the unemployment rates as well as credit scores. And this really is going to predict the home prices appreciation over time and just how quality a real estate investment market is. So we go to the next slide, we can see a broader scale. And these are including small and larger markets. But you can see the number 4 is Denton, which is also up there in the Dallas area. Then you've got Allen also up there in the Dallas area. So many of these Dallas area markets are crushing this metric, which is not surprising because we see that really being a resilient area for home price appreciation. And so many people and jobs moving into that area, it's not surprising that it would really crush these numbers. The other interesting city there, Austin, despite the fact they are down 10%, this data and this organization, along with others, also feel that Austin is due for a bounce back. I tend to agree with that. It needed to correct, but I don't see that correction being like we come back 4 years from now. I don't see that being an ongoing trend. I don't know exactly when it's going to bounce back. I think rates are going to play into that, but I do see it being one of the more stable markets out there. What do you guys see from this data, Steve and Jeff?
Yeah, well, the part about Austin that makes a lot of sense, if you look at the back page on that, how they came up with the number, job rate, population growth. We've been talking for the whole year about how people are moving to Texas. So that definitely plays into it. Employment, underemployment, I'm not sure what that is, but just the overall health of the economy, in Dallas especially, like Dallas economy is going gangbusters right now. So the overall health of the economy plays a large chunk of this. So it totally makes sense that half of these deals, half of the top 10 is Texas. 1, 2, 3, 4, yeah. 1, 2, 3, 4, yeah, half of the top 10 is in Texas.
Dallas and Austin are also the 2 cities that had the most relocations for large businesses also. So they're gonna continue to have transient population growth, and I think it's gonna continue to be a safe haven for companies to move into in the state of Texas. They've established these large campus areas that they continue to build and are ready to receive and give the correct tax breaks to the companies that are coming. So I think it makes sense that all of those submarkets of DFW are there, and then Austin as a whole, just because it's just not as expansive as DFW. So I think that's going to continue.
If we go to this next slide, go ahead, Jeff.
No, I was just going to talk about, like, you look at affordability and economic environment. McKinney and Frisco are 1, 2. I mean, they're 2, 3 in real estate, so that's not bad either. But they really drive that home. Allen as well, top 5.
Yep. Let's go to the next slide because I think this gives a little bit of a broader view. It's a little bit hard to read, so I'm going to cover the numbers, but this is covering the major metros, right? These are the biggest cities in the country, peeling out the suburbs like the Dentons, the Allens, the McKinneys. So Nashville being number 1, Austin number 2 there out of the major cities. That's a very exciting number for the Austin investors. Fort Worth 7. We've got Dallas at 12, and then Arlington 20 and Houston 21. So this is not just a buy and hold evaluation, right? This really emphasizes things that are important to flippers as well. So I think this makes sense with some of the numbers that we were covering earlier, but to have, for all intents and purposes, it looks like 5 of the top 21 markets for future here in the greater Texas area. I think those are very exciting numbers. And then if you think about it, if you're in the Dallas area in particular, weighting some of your emphasis north of Dallas, and we see that happening in the borrowers that are coming to us at a very high level. There's a consistent, aggressive approach, even going beyond north of the McKinneys and the Allens into really approaching that Oklahoma border. And I actually listened to a podcast recently, a Bigger Pockets podcast, where one of the presenters was talking about their heavy focus just north of the Texas-Oklahoma border, and that those people were still commuting into those north of Dallas areas where these corporate headquarters are. Because most of those corporate headquarters are being housed in that, Plano, McKinney, Frisco area. That's one of the biggest corporate headquarter focal points in the entire country.
So top new home metros since COVID. Now these are permits. We got this information from Texas A&M report. If you just look at the chart there, 3,000 permits is the baseline. Say for Houston is the orange and DFW is the blue. Starting, I guess this starts back to, maybe we'll call it January of 2020. So for the last, 3.5 years, Houston and Dallas have been dominating. They have, and there's a slide later in the presentation that'll show how they're doing relative to the rest of the country. But Houston, Dallas, then you got Phoenix, Austin, and I guess Charlotte, North Carolina. These are the 5 top markets for new permits. But it's not even close. If you look at the top 2, Houston and Dallas are building so much more, trying to keep up. I just think this is very interesting. You're talking about all the new builds earlier, Steve. They're trying to build a lot.
Well, I think they understand that they have an opportunity with people that are in a very low locked-in rate for a single family. If they are not going to list their home on the market, the new home builders understand that they have an opportunity to build a lot of inventory and not have a lot of competition, which is where we start to explore, we're turning into a market where there's a lot of opportunity for flips potentially. Wade, we talked previously, I don't know if this is the slide you want to talk about, but there's a lot of people that are betting big on new construction.
Yeah, I think this is an appropriate time. And you and I were discussing the Warren Buffett, Berkshire Hathaway move the other day. I assume that's what you're talking about, which we kind of deep dove some of the numbers. I think he has about half of his money in cash right now, which is, he's very smart, maybe the best investor of our generation. And he's a little bit older than all of us, so I guess maybe the previous generation as well, but he's still going strong. But he has a lot of money in cash, but he put a significant amount of that cash into 3 major national new home builders. So he feels nervousness about the overall stock market, but feels great about buying stock than any of us can buy in some of the biggest home builders in the country. With an emphasis in the South, those home builders do have an emphasis in the South, the ones he went with. But it's very logical because of what Steve has been talking about from the beginning of this. There's a complete lack of inventory, but still a desire to buy properties. They're only going to come from those homes because unless rates come down, nobody's going to, not nobody, there would be a very important reason for someone to give up a 2.75 or a 3% rate to go buy another home whenever you know what current interest rates are. So people really want to hold on to that. So that I think we're going to see a lot of new home construction. And if, as an investor, you're able to get a deal that can be profitable as a flip, you're going to be, for all intents and purposes, one of those few opportunities that an individual investor has to get into a market that someone like Berkshire Hathaway or Warren Buffett is doing. You can create that on a minor scale within your own investment strategy by providing some of that needed inventory. This next slide, this is the metro median days on market for the 4 major areas. And, the thing that we saw, which was anticipated, the initial shock of higher interest rates, you see a really, really big spike there, right? Then, as people started to get more adjusted to those interest rates and to understand that there is a limited amount of inventory, we saw those days on market start to come back down. And if you look at this historically, while it is higher than what we've seen since probably 2014, which was a very, very low interest rate environment, it is not unreasonable compared to what it was, at the beginning of the, around 2010 in 2011, 2012, still lower than that for days on market. And as I think most of the people on the call probably know, but may not know, 6 months is about a normal market, right? And we're not anywhere close to what people consider a normal market. We're still way, way below that across the state of Texas.
It's really almost back to like, it's at the end of 20, I guess the beginning of 2020, it looks like it's, I mean, other than Austin, those numbers are pretty similar to where it was 3 years ago. So it's not, like you said, like they had the initial shock, but they've come back down to where they're basically the same as where they were in 2020.
Yeah, pre-COVID, we're basically pretty much in line.
Yep. So I'll just I'll hit this and then you guys can talk about it because I know we talked, Steve, earlier about new construction. So this is a chart, months of inventory, when it compares existing homes relative to new construction. So if you can look back in 2010, there was a lot more inventory of existing homes than new construction. And I guess we're around maybe 14 that kind of crossed over, stayed pretty consistent up until COVID. Both those numbers took a nosedive, and then it kind of looks like it's starting to widen back up again, where there's a lot more inventory of new construction than the existing homes. And it kind of goes to what Steve was talking about earlier. There's a great opportunity for the home builders, and not a lot of folks want to part with their current mortgage. So you're going to see low inventory for those existing homes.
Yeah, I think there was another slide, we may be getting to it, but I think we were getting close to the widest gap in inventory between new construction and existing homes that we've had in quite a long time. Because if you look at the COVID years, construction costs, even though money was cheap, construction costs were so high. Lumber went from $350 for a 1,000-foot yard to $1,400. So you started to see builders cancel contracts. You started to see builders, we'll only do four at a time, and once the frame is up, we'll lock in your price. And now that lumber has retreated to pre-COVID levels, they understand the opportunity, and they are definitely going after it. They are getting as many permits as they can. They are doing as many land development and acquisition loans as they possibly can. And it's not just the large builders, the medium-sized builders are trying to grab any parcel of land that they can, get zoned residential and start building homes, because they understand that they're going to have, maybe depending on rates, 3, 5, 6 years of runway where they're going to be able to drive the inventory.
Yeah. New home builders will have enormous impact on prices in given markets for sure, because there's going to be so few options outside of them. So it could really present an opportunity for that appreciation that, it's kind of been hovering flat in most of the Texas markets. But I think, especially coming into next year in the primary buying seasons, I think we could really see some nice appreciation again. So next slide, please.
Next slide.
And Steve, I'll let you run with this slide. Whenever we were going through our prep meeting, you did an excellent job of breaking this down. So.
Yeah, so this is just a little bit of hope for you. If you've never looked at or understood the correlation between the 10-year Treasury and 30-year mortgage, so mortgages are traded in a security called mortgage-backed securities, okay? And historically, if you look at that blue and red line, they have about a 1.5 to 1.75 difference between where the 10-year Treasury trades and where mortgage-backed securities trade. That's the historical correlation between the two products. If you look right now, we have the widest gap of margin between the 10-year Treasury and mortgage-backed securities that we've had in recent times, right? And what that means is they're oversold, the margins are high, people are demanding more because they do not know what's next for the orange line, which is the Fed funds effective rate. And once we know that they're going to either pause indefinitely or back off of that, the correlation between those two will get back in line, which means even absent of a Fed rate cut, you can see rates improve because the margin between those two is at the highest level it's ever been. It's almost 3%. So just normalizing that margin could garner us a 1% increase from today's market rate, which would be a very welcome thing for the housing market.
You said increase, I think you meant decrease, right?
Well, yes, yeah. You could have a 1% decrease if we just get that margin more in line with where it normally correlates. We could take a current market rate, and decrease is the correct word. You could have up to a 1% decrease absent of any Fed cutting of any rates. So we're outside of the scope of what we're normally at in this correlation. Bonds are oversold. They don't know where to price because they don't know what the Fed's next move is. But once they do know that they've either indefinitely paused or, they just say, we're going to take X amount of time off from cutting rates, and the jobs market is starting to soften. So that I'm hoping that they'll be a little less hawkish moving forward. Once that gap starts to narrow, you'll start to see rates improve, even if the Fed isn't doing rate cuts. We don't expect Fed rate cuts until 2024, maybe early Q2. But you could still see rate improvement even absent of those cuts just by getting that back together. A lot of people don't know there's a correlation between those two. Historically, it's 1.5 to 1.75. We're pushing 3% right now.
Yeah, I think that's a great breakdown because you hear Powell speak and it doesn't give a lot of optimism of any improvement in the interest rates in the foreseeable future. But to your point, we don't have to have that. I think if we could just get a more normalized delta between those two, it could really make a difference. And I do believe that if we see just any positive movement in there, because it's such a big difference. If you get a 1% drop from where we are today, that's such a profound difference in the gap between people's current rates and going and buy a new property. And also for the people that are in the market, just so much more attractive prices overall that will really see some traction because there's a lot of pent up demand.
Well, even if we just have a brief period where we've normalized a 6% rate, if they go to 5, the person that has the 3.5 may reconsider listing.
Yeah. All right, this next slide.
Yep. Thanks, Steve. That's
a great breakdown. So this next slide is a really good breakdown of historical interest rates, and it is painful at the moment because of the gap from where we were. But it's so important whenever you see a slide like this to understand that before 2009, there were never rates lower than where we were before, and really never rates lower than where we are today. So it's all relative in the overall scheme of things. So I think you can still get into a home at a reasonable price, and that's why we're at a reasonable monthly payment. That's why we're seeing people do it. But the challenge is the inventory, and that people don't want to give up what you see there in 2021 and 2022. Those rates are so incredibly low that's the challenge. It's not necessarily that people cannot afford at the moment. It's a little bit tighter because the rates is that people don't want to sell as much, and that's why that new home inventory is just so crucial.
Yeah, I will say that one thing we're seeing is one of the largest home buying pools is the 30 or lower, right? Some of them have never seen an interest rate above 4 until this year, ever. So it is a big sticker shock for them. And what we saw during COVID is with money being cheap, they were willing to take on renovation projects. They were willing to, use a renovation loan. Now they want turnkey, period. I'm going to pay 7.5%. I want turnkey. I want to move into something I don't have to do anything to, that's been completely renovated. And again, that's something that as a real estate investor, you have an opportunity to do. And I will say that I'm talking about flips being an opportunity a lot. I know I'm the owner occupied guy, but I have done 6 flips this year. So I'm not just a person standing up here saying there's opportunity. I've executed this in a year where rates have been higher than ever. And it's because I know that there's no inventory. So I think it's going to continue to be a strain.
For sure.
Okay, next slide. So this is part of the chart you were talking about earlier, that this is new homes make up a near record share of housing inventory. So I'll just read the slide and then take a look at it. So newly built homes made up nearly 1/3 of US single family homes on the market in the second quarter. That is the highest share of any second quarter on record. So this is a measure of the market, and of the market, how many are considered are new homes versus existing homes. And this just kind of puts the final nail in the coffin on what we were talking about, which is there is just not a lot of existing inventory, and the new builds. So let me ask you, the new builds are the percentage is rising. So let me ask you, Steve, so with all of the permits that are out there and the building that's going on, would you expect this number to climb even higher? Because this is, like, I feel like, to your point earlier, they're behind a little bit because of the prices, and they slowed down during COVID. I have to believe this number is going to keep growing until those rates go back down.
Yeah, oh, for sure. Yeah, I think it could get to 50%. In that outlier that is Q1 of 2022, what happened in Q1 of 2022, that's when rates hit 3.9 for the very last time, and they went to almost 5 overnight. They had started to come back down from Q4 of 21. They'd started to come back down, and I believe January 3rd, we got a really crazy jobs report. January 6th was State of the Union, and rates have never been in the 5s since then. Never been in the 4s since then. So that was a real quick blip, and it just stopped the resale market for about 2 weeks. Everybody freaked out. So that was an outlier. And then from that point on, the builders have known exactly what their opportunity is. So I think it will definitely continue to go up.
And I think outside of this, that one blip, kind of an anomaly type month, this is the highest, not just highest Q2 number, but highest number ever from what we saw, if I remember correctly. So it's a very, very interesting dynamic that, and we're always talking about the individual investor. Nobody on the call here is going to probably be a huge home builder building, thousands of homes annually. But how can the mom and pop investor get into the game? You can do it like Steve Curtis is doing it right now, right? You can get in by flipping properties, or maybe even doing some new construction on a smaller scale. But either one of those are very good approaches. The only tough thing with the new construction is that you don't know exactly where the market's going to be in 18 months. But I think it's all the prognosticators seem to think it's going to be very strong. You can get into the flip market and be listing a property in 60, 90 days, and it's much easier to predict that market. Much easier. So this is the new versus existing home sales chart over time, and you can see going through, this goes all the way back into, it looks like the 1960s or so. So we had the new home sales back then, then it looks like we started keeping track of these existing home sales and those percentages. And you have to do some back of the napkin type stuff, but you can just see the trend over time where those new home sales were such a huge part right before the great financial crisis, then a huge dip whenever there were no new home builders building almost any inventory whatsoever, right? It just totally fell off the map. And for a very long period, we were below any of those previous decades until recently. We're finally starting to get up to a normalized new construction market. But existing home sales definitely dipped in that same time, after the great financial crisis. But and we're still not really back to where the existing home sales were at that peak right before the great financial crisis of 2007, 2008. Anything else to take away from this one?
Yeah, just as a correlation, it was 8% in 2010. 8% of home sales were new.
Wow.
And now we're 34, 35 and climbing. And if we had more data, if you can go to the next slide again, if we had the last 3 months of data on this, you would see it even more. I mean, existing home sales are 3.6 million. The new home sales on this slide, which they don't have, is making up 34, 35% of that and climbing with the permits. And localized to Texas, if you look at the permit numbers, those markets that we talked about are going to continue to have inventory created through new construction. Another one that barely showed up, I think it showed up on there, but maybe it didn't. But if there's anybody in the valley, there are some cities in the valley also that are having new construction booms as well.
So we cover this chart on most of our calls here. These are housing starts, and it just kind of gives you a good perspective. We've been talking about housing and starts, but it gives you a good perspective as to part of the issue we've had is over the last 10 years. If you look from 10 to 20, I think that's the lowest decade we've had since, I believe, the 1950s. There just wasn't a lot of home building going on. So that explains, that's part of the reason why there's such a big run up now. Obviously, the things we talked about earlier are part of it, but just nobody was building houses, say, for the last 10 years. And it looks like over the last 3, we're trying to catch up. But this is part of the reason why, especially when you look at the next slide relative to the population growth, they were not building enough houses over the last 10 to 15 years until just now, basically.
Yeah, if we go to this next slide, you'll see that the the population at the beginning of this, which might have been 1992, was maybe 250 million. Now we're approaching 335 million, and we're still not building as many homes as we were pretty much whenever the population was maybe, I don't know, 260, 270 million. So we still have so far to grow on our new home construction relative to the population. So that's why most people really believe, including the Warren Buffetts of the world, that home prices have a lot of way to go up over time. The big weight is rates. That's not going to be there forever. And the more it normalizes, if let's just say we never get back down to 2.75 again, which there's a very good chance for a long time we will not, things will eventually normalize, right? People have to move for work. They move for other reasons. They have to, they have a family and they have to get a bigger home, or they get older and they want to have a smaller home or a one-story home, right? There's all these different factors. Once things become normalized, I think you're going to see more movement. That's inevitable. But in the absence of just a massive increase in new home construction, I don't see a way in which we're going to say all of a sudden we have an oversupply. This next slide is awesome. So we're going to break this down real quick, and I'm going to turn it over to Steve to talk a little bit about it. But if you look at this, this is new privately owned housing starts relative to population. So this is for every 1,000 people, how many new home starts are there, right? And so if you look at these numbers, you've got Florida and California at 171. Then you have Texas at 347, nearly doubling those numbers. And no one else is in the ballpark. No one else is within range of those 3 states, which is really an incredible number that Texas would be so far and above everyone else. And I do remember, I don't know if it's still the case, seeing that California housing starts number being where it is, but there was a time when there were more housing starts in both Houston and Dallas than in the entire state of California, which is a pretty amazing statistic as well. But this is, whenever I saw this chart, I was kind of blown away. What do you guys think?
Yeah, I think it just mirrors what we've been talking about. Texas continues to be probably the healthiest housing market. It's always been well centered in the midst of all financial, doesn't matter, good, bad, ugly. But with the combination of having good affordability, lots of transient buyers moving here, lots of corporations moving here, we have our own population growth. We essentially have our own economy. Our GDP is higher than like 150 countries when you look at it. So it's just such a popular destination to live. It would be interesting to know if the 347 number even is keeping up with demand.
Yeah, I agree.
Yeah, if you look at the, I mean, it's just, other than California, if you look at just a chart of population growth, it almost mirrors this exactly. Like Texas, Florida, the Carolinas, Tennessee, like those are the big ones. New York and California seem to be outliers because their numbers here look respectable relative to their population growth. But for the most part, yeah, Texas and the South is just tons of people moving here, and so they're trying to build as many houses as they can, keep up.
And we still have a lot of area to build.
Yeah, it's a big place.
All right, next slide. So this is the rental vacancy rate, and as you can see, the vacancy at the moment is really lower than it's been in a long time. So for buy and hold investors, these are very attractive numbers, and it makes a lot of sense because there are fewer homes being purchased. So it's logical. And if you notice, the only time that it was lower is whenever rates were even higher than they are today. that 1970 to 1980 period, rates were, 12, 18, 16%. So there were fewer homes being bought. And because of that, the rental market is very, very robust. And in areas where you can increase rent rates, people can very aggressively do it because there's so much demand. And the other thing is, you think about it, people are always making the comparison between buying a home and renting a home. And if it costs exponentially more to buy a home because of where rates are, people, that comparison for landlords becomes very favorable, because people can say, if I bought a new home that's a 3-bedroom, 2-bath in the size range I need, I've got to pay, $2,400 a month. I can actually rent at $2,100, and that's a good gap for me. So we can continue to, as landlords, increase rent rates because of the higher cost to buy it.
Yeah, I mean, we've been talking a lot about flipping, but we haven't. This is still a great rental market, because if you look at that, like the rental vacancy is so low, you can increase rates or rental rates, like you said, and we're still seeing on the hard money side, we're still seeing really good equity capture on our deals. And we did one the other day where they were zero out of pocket. Now that's not every deal, but it's still significantly lower now than it was during the height or pre-COVID. Cash out of pocket is less on a lot of deals. So it's a great time to get into a deal. Even if we talk about it all the time, even if your cash flow is lower, rent rates are going up. And like I said, when rates go down, you can always refinance, and that is an instant boom to your cash flow. So it's still a really good time to buy rental properties.
For sure.
I guess Steve's had enough of us.
I'm sorry?
So I guess Steve had enough of us. I think he technical difficulties, or I don't know what's going on.
It's been an adventure today. Probably the most adventure we've had in the podcast, or I'm sorry, webinar, but I think we've kind of muscled through it, and it's going well. I did want to make one more point on buying rental properties, which is that we sometimes hear people talk about going into other markets, for example, other cities entirely. And that can make sense, and we have a lot of California investors in Texas and things of that sort. But with an overwhelming amount of people that want to invest in these 4 major metros, if you're having a bit of a tough time getting a property with the equity capture and rent rates that you want to see, focus on going a little further outside of these major metros that have all these great economic numbers, all these great vacancy numbers. It's going to be difficult if you're right in the middle of Dallas, Houston, Austin, San Antonio. That's not an easy thing to do. But what we see people, we actually met with a client at a big mixer we had the other night. They've done 20 different transactions with us, and they have 2 deals where they're out of pocket under $5,000, but they went a little bit further out, right? I think one deal was in Highlands, maybe one deal was in Dayton, and you still are able to have all the attractive things of the job market of Houston. People can travel to the southeast part of Houston, where there's this overwhelming blue collar job market with refineries and everything, but you can get very attractive prices, and there's not as much competition. So that's one thing I'd encourage you to do. Go somewhere where you can still drive if you can. If you're in one of these great markets, then be comfortable driving a little further to get a great deal.
Yeah, I was going to ask anecdotally, Steve, I know you did flips, and we're talking about, I guess, buying holes for that client, but were your flips, were they more city, more rural? Did you have to go a little further out for your flips, or are they all relatively metro or suburban at least?
I think if you think urban, suburban, and then just outside, that just outside fringe is where I found the best deals. I did do one in Webster proper, which is just outside of Houston, but Dickinson was a good area. Texas City was a good area. Areas of Brazoria County have been good, just because there's been better deals. Did one in Santa Fe that was very successful. Highest price in that area we were able to obtain because it had a little bit of acreage. So I think everything that you guys just said, there are opportunities. If you're willing to just maybe put a few more miles on the odometer, I think you can find some deals.
Sure. And that's not too bad. Like Santa Fe, that's not as, I mean, Dickinson, they're right on 45. They aren't so bad. Like you don't need to go to, the middle of nowhere to find these deals. Just a little bit slightly off the beaten path.
Mm-hmm.
Okay. This is our last slide. We talk about it. We'll just hit it. This is the affordability index that Wade was mentioning earlier. It's a measure of mortgage payment and the cost of living in a property relative to your income. So for example, Miami is the most expensive. You take the average home price, average mortgage payment, average household income, and that number comes up to 80%. So for the average citizen, 80% of their income would go to their mortgage payment. And then it goes on down from there. As you can see, Austin, Dallas, Houston, 21, 22, 34, and then the smaller towns down from there. San Antonio is all the way down to 60. So still very affordable, especially when you think about what you get for living in those areas, the amenities, more of the same what we've been discussing, but it is it's still a very affordable, even with the price increase, it's still a very affordable place to buy and invest.
Yeah, one thing that interests me on these charts is just the improvement in certain markets for affordability. For example, Houston is one. Houston was the 24th least affordable city back in 2019. Then it was the 36th least affordable city, in July of 2022, and now it's about 34. So you can see that post-COVID, Houston became significantly more affordable. I mean, people may not have thought that would be the case, but it is significantly more affordable at the moment. And you see some same numbers outside of that. We also have San Antonio, which was 55, 54, and then now it's 60. So some of these markets, despite the fact that there's steady home values in these markets, it is becoming more affordable in comparison to the rest of the major markets across the country. So still a good indicator of where we're going, in the next few years for those markets for sure. All right, so I think, go ahead, Steve.
Oh, I was just going to say just a little thing I thought about, because my daughter is trying to be a veterinarian. Lubbock is an area that is just opened, only the second vet school in the state. It's going to bring in another 2,000 to 4,000 students from freshman all the way through degree. And it is the highest affordability factor in Texas. So might make sense to pick up a hold there, because I think rentals will get stronger there as more students come to that area.
I'm not sure if that was by design, Steve, but we do want to let everyone know that we are very comfortable lending in those top 25 markets outside of the major metros. We do transactions in places like Lubbock. Certainly in Beaumont, we consider that one of our core areas, Beaumont, the Golden Triangle, but done deals in Corpus Christi and other places like that. So if you are considering that, if you have a kid going to college somewhere and you don't just want to pay rent for 4 or 5 years, that can be a fantastic investment where you're able to actually bring in other roommates along with your child, cover your rent plus, and then often have a nice, end of the rainbow whenever they move out. You can potentially sell that property with a lot of appreciation, or maybe hold it long term. Who knows? It's a great point. All right, so going to turn it over to Derek. I think we may have one question from the crowd, and we just want to squeeze in one because we're a little bit over, and then we want to announce our winner for the contest. So Derek, you have the floor.
Absolutely. The good news is, with us being short on time, that the question was exactly related to what you talked about the tertiary markets, with the fact that Frisco and McKinney are the ones in the Wallet Hub study. They were just referencing how that impacts your strategy being right there in the middle of all the higher end type properties versus going to outside the city. And if you want to reiterate or speak to that based on what you talked about, how to win.
I would not consider that necessarily a tertiary market. I think that's a core market because it's like a major suburb. Whenever I'm talking about that, it's probably a little bit further out, right? A little bit further towards that Texas-Oklahoma border. If you're talking about Houston, you might give an example of the Woodlands and then going a little bit north of the Woodlands to Conroe or something like that. If you're in Kingwood, you're going up to New Caney. If like Steve, if you're talking about Steve lives in Friendswood, but then he's going down to Santa Fe or something a little bit further out. So it's not like you're talking about hours or even significant distances. It might just be an extra 15, 20, 30 minutes where people have to maybe commute a little bit further, but that price point's just going to be down low enough to where it's an attractive flip market, but also very attractive buy and hold.
Awesome. And then the winner of the drawing that we have each time is half off your hard money loan processing fee. Today's winner is Mark Bauman. So Mark is
John
one
Mark.
today, and
Mark.
then Wallet Hub has said apparently Dallas is the place to be, and so that kind of fits in with our plans for September. Wade, do you want to tell them about the
Yeah, we have a
event?
big event coming up September 13th. If you would like to know about it, it's going to be in Dallas. You will have to say the exact location. I can't remember exactly, but we're very excited. If you want to attend that event, it is open to the public. We just had an excellent VIP mixer here in Houston. That is an invitation only event that we did last time in Houston. But if you are someone who wants to be a person who can attend that, please reach out to your loan officer to find out about how you could do that. And if you don't have a loan officer currently, please reach out. That's only for our pre-approved borrowers. But in Dallas, we're newer to that area and we are opening it up to everybody. So if you'd like to attend our event in Dallas, give them a little bit of detail on that, Derek.
Absolutely. You can find it on Eventbrite. You can find it on social media as well for Catalyst Funding across all those channels. And it is September 13th at the Bar Louie. We have a nice separate private, large private room reserved there. Great place, great for networking. And it's September 13th, right next to the Toyota Music Factory in the Las Colinas, Irving area. Great area for networking.
It's a cool spot.
Absolutely. Yeah, it's a
Cool
fun,
spot.
fun venue for sure. Okay, well, we're over it today. I appreciate everybody working with us through some technical difficulties we had. I again apologize for not being here for the start. I am thankful that I did not have to evacuate and everything was burned down, so that's good. But sorry for the difficulties, and everybody happy investing. I think it's a great time. If you have any questions on non-owner occupied deals, please reach out to us. Also, with Stevens Group, I do want to mention we closely are integrated with them. They handle all the owner occupied stuff. We handle the non-owner occupied, and with one credit pull, you can have access to everything. You can flip properties. You can get your primary residence refinanced to fuel your investment goals. If you want to buy a new property, you can use that in all with one credit pull. We're closely integrated together. We team up very well to be a one-stop shop for whether you're doing something owner occupied or whether you're doing an investment.
Appreciate you, Steve.
Right.
Thanks for hopping on.
Yeah, thanks for having me, guys. It was a great discussion.
All right. Have a great one.
See you guys.
Thanks, everybody. See you next month on the Real Estate Market Update.
Absolutely. Thanks, Derek.